Hi, it's Dave Armstrong, 26th of August, Monday, and welcome to what I am now going to start calling Sticky Note Logic. Thanks for all of the great feedback I got last week on using the sticky notes to explain the yield curve inversion, what's happening with bond prices and yield prices. And I mean, really, I was totally stunned. I had text messages from friends and family, and emails from clients, and phone calls, and stuff on social media. I was just blown away. So because I got so much great reaction to that relative to what I hear about when I write a blog or the other videos, I decided I'm just going to keep using the sticky notes. So with that said, I just want to go over my thoughts on some of the market volatility that's been happening lately. But I want to start out with this, and this should come as no surprise to anybody who's been watching my stuff or reading my blogs. But slowing growth does not mean we're in a recession. Okay, everybody was just totally fine when we had 2% GDP for like 8 years, and then nobody was screaming recession. Then we go to 3%, and then we come back down to 2%, and there's like tariff news and Trump tweets, and the whole world goes freaking nuts, and we're at 2%. I mean, let's just keep it all in perspective, okay? Because it really is true. Slowing growth does not mean the same thing as a recession. Okay, we're not there yet, and there's not a whole lot of data there that's really substantiating that we are in some sort of recession or that we are very close to a recession. Okay, but a lot of this, TV drama, Twitter drama, president, tariffs, back and forth with China. I mean, last Friday, the market takes a dump because of the hardline stance on China, and then come out today, and he's like, well, maybe we'll figure something out. The market's up 200%. I mean, you just can't predict these things. Okay, so how do you survive in an environment that's got a lot of volatility? Okay, again, this shouldn't come as a surprise to anybody who reads my stuff or has been around me for a while, but having some clarity in your plan and your investment strategy is going to remove a lot of uncertainty. Okay, and what does that? Okay, great, Dave. Blah, blah, blah. What does that mean? Okay, here's what it means: don't sell stocks if you don't need the money. I mean, that's about as simple as it can get. Okay, and if you have a plan and you know what you are trying to achieve in the future, there's no sense in trying to mess around with the stuff that's going on in the market today. Okay, so I'm in my early 50s. I mean, I know I look like I'm 28 years old because my hair is brown and I still have it and everything. I really appreciate that compliment. But I don't need let's just say my IRA money, right? Like, I mean, the chances of me needing that money inside the next 10 years is zero, right? So why would I be doing anything right now with that sort of money? Well, the answer is, well, Dave, what if you did need the money? Okay, so I'm going to talk about that in a second. But this is something else I preach all the time too. Like, simplicity is the best way to handle volatility. All right, like, so don't start falling for any of these great ideas or brilliant strategies that you hear, like the guys with the ponytails on CNBC talking about options this and overlay strategy that and puts and blah 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 blah. Forget all that crap. Okay, just have some order in your life, have some order in your plan, and keep things into perspective. Okay, so here's where some sticky note logic comes in, because I just want to put this whole thing into perspective. Okay, so here's what happens, right? You're an investor and you've got a portfolio value, right? And here's what's happening. Okay, let me get down here on the very edge of the screen, right? Okay, you're like, great, I'm invested, I'm making money, the market's going up, whoop, then it comes down a little bit, and then it goes up a little bit, and then it's coming down, and then it's doing this, it's doing this, it's doing this, and all of a sudden it's up here, right? Okay. Then all of a sudden, something comes along, like the other day, or this week, or December of 2018, and all of a sudden, boop, 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 your portfolio goes down here. And this is what you say, right? This is what people say. Holy shit, look at all this money I've lost. Well, give me a break, okay? Because 2 years ago, this number was down here. And if I told you, like, hey, this number is going to be here someday, you'd be totally psyched about it. What you're not psyched about is that it went like this and then like this. Okay, so let's keep things in perspective, because over time, this is happening, and you don't have to worry about this coming down like that, right? So to put it out of your mind that you've lost money, okay? The only way that this going to this equates to losing money is if you need the money, Okay, and that's where I'm going to get back into this whole thing about raising cash. Okay, so if your portfolio value is going up and going up and going up, and it gets to a high, okay, portfolio high value or some sort of high, like like in other words, more than it was down here. It's up here, right? Your portfolio is doing really, really well. And you're like, okay, I need money to buy a house. I'm going to retire. I'm going to start needing money. I'm going to retire in the next 18 months or whatever it is. Okay, you need cash, you raise cash. That's what you do in an environment like that. So then when the market goes to here, okay, you haven't lost money because you raised the cash up here. Okay, where you run into trouble is this goes along and you're like, woo, the market's going so great. I'm not going to sell now because it's just going to keep going higher. All right, well, sometimes it does and sometimes it doesn't. And then all of a sudden, bam, you're here. Okay, and then when you're here, and you need cash and you raise cash, well, then you did lose money. Okay, so the whole idea is the best thing to do to handle some volatility right now is to ask yourself, okay, yes or no, I need cash in the next 12 to 18 months. If you need it, I'd even say that it's okay to raise it now. I mean, the Dow's at 25.8. Okay, remember where it was 4 years ago? It wasn't 25.8. I'm telling you that right now. So it's even okay to raise cash right now. But if you don't need the cash, just leave the whole thing alone, okay? And if you do need cash, I'm telling you, it's fine to raise it right now. Or if you're retiring in the next 12 to 18 months, you need cash, it's okay to raise it right now. But the whole idea is that you want to raise cash when the portfolios are up around in here and not down here. And it's just as simple as that. Because when you hear people talking about hedging, all these hedging strategies, buying puts and options this and hedge funds that. I mean, there's a ton of different ways out there to hedge your portfolio, but a lot of them are expensive and a lot of them are very tax inefficient. Okay, here's the best way to hedge your portfolio. Here's my secret of the day for anybody that's watching this thing and you really want to hedge your portfolio. Okay, first of all, you shouldn't be hedging unless you need cash. Okay, if you need the portfolio value up here, like if you need all this money to where it grew and you need it, then you raise cash. Okay, and when you raise cash, you're hedging, because the best hedging vehicle there is out there that I believe to be the best hedging vehicle is cash. Okay, you don't want your portfolio to go down when the market goes down 1,000 points, or if there's a recession, you don't want to lose money. Raise cash. Simple. You're going to pay some taxes on it if you have some capital gains. You're not paying a whole bunch of options, overlay strategies. Just raise cash. Cash is the best way to hedge your portfolio. So come back to the whole thing again, which is, look, if you need cash, you're retiring, you're buying a house, you have some sort of need for cash, raise it. Okay? If you do not need cash for the next 12 to 18 months and you're just living, out of your salary and paying all of your expenses and you're not even close to retiring, you're not close to buying a house or some other major purchase, leave this all alone. Okay, and that's what's so great about having a plan and looking at it like that. So, all right, with all that said, I'm going to wrap up. Thanks a lot for all of your great encouragement about the videos. I really enjoy doing them. I will keep writing, but this is sort of a new thing for me, so I'm playing this out a little bit. Got all the social media stuff down here. Do all the stuff that we ask you to do on social media. Click, like, share. It doesn't seem like a big deal when you share things, but it actually really helps us. So if you're watching these videos and you're enjoying it, I prefer a share over a like, but I'll take a like over just doing nothing. So please give us a call if you have any other questions, and look forward to the next segment of Sticky Note Logic. Thanks, everybody.